But I think we got everybody here today. If you don't know me, my name is Craig Schwein. I'll be your presenter tonight. As you know, tonight's presentation is how to find stocks to trade. This will apply to some of you. Some of you are more day traders, and this may not have as much application to you. But we'll also be going a little bit into the how to build scans, so maybe you can use that to help narrow down your searches for to start your day. So before we begin, we got to kind of go over the disclaimer. All right, so the disclaimer, obviously this is for educational purposes. I am not a stock advisor. I'm just here to help you guys learn and learn from you guys. So trading's a risk. Just be careful when you trade. As you know, there's thousands and thousands and thousands of stocks to choose from, and that's just the stocks. Then you got ETFs, commodities, futures. So how do you really decide which stocks you want to trade with? There's so many different ways you can go about it. Really, today's lessons are just the different avenues you can go about trying to find stocks that you want to trade, whether it's a short-term swing or if it's a long-term investment for you. Some of the different areas that you can look at are the external suggestions or stock tips that you get from people. Segment rotation is a very popular one. Stock screeners is the one that I tend to use the most. And then just kind of talk about watch lists and how to kind of pull it all together and keep track of all that. So external suggestions. This is obviously one of the easiest methods to get stocks because everybody and their brother's got an idea of which stocks to buy. And they'll be happy to share that with you. Some people are dead against it, like, I will not buy a stock tip. Well, you shouldn't, but you can take that information and go research it yourself. It's an idea. Maybe they did hear something that was actually valuable. But you don't want to just run out and go buy it just because they said that, it's a great idea. What you want to do is just take that idea, internalize it, and go research it yourself and see if it fits within your type of strategy. There's a lot of different sources you can get it. Obviously, you can get it from friends, but some of the main areas are the media, like newspapers, magazines, TVs, online. With the internet, there's millions of different ways to find stock information online. News aggregators, blogs, and actually stock communities. And then you also got stock picking services. And like I said, you never really want to ever buy just because somebody said to buy it, it's a great tip. You want to take it, go research it yourself, and see if it fits within your strategy. So the first one I want to kind of go over is the print. The benefits is that, they have a lot of people that do this research and analysis for you, and then they'll put together a report or an article. So they've done a lot of research for you and provide a lot of information up front to you, so you don't have to go find it yourself. Plus, they've also got people that this is their lives, so they understand the economy, global economies. They understand, the economic outlook and the different facets of it. And usually they take that into account when they do these different reports. You got newspapers, magazines, and TV. Within the newspapers, I grabbed a few of them here. You can actually get them right here in the library, so you don't actually have to do the article, but you got the Wall Street Journal, the IBD, which is Investors Business Daily, which is kind of a growth stock type investment strategy. And what's nice here, too, is they've actually got the top 50 stocks that they believe in and the research that they've done. And Barron's, so here's another one, Barron's. So if you're going to get all these newspapers yourself, either the online or the print version, it's going to cost you a lot of money. Just realize you can come to your local library on the weekends or even after work and get a lot of that information for free. You've also got magazines that you can skim through, and got several up here. You got Incorporated, Kiplinger's, Money, Fortune, and Entrepreneurs, and these are just some of the magazines that are out there. You could just flip through them and just see if there's an upcoming company that you want to invest, that might be a good potential buy for a long-term investment, or maybe a new product that's coming out that could really revolutionize. Think about if you read an article on the iPod years ago, an Apple when it was nothing. So, these are great ways to go about and try to find different companies and getting information that's just not available through your broker. And of course you got TV. Everybody's heard of, Kramer. He's not my favorite, but every once in a while people are still calling in about ideas, and he still, he does have industry knowledge, and sometimes he does have some insight. So every once in a while you could maybe hear about something, and take it and go look into it a little bit further. But you got Bloomberg, and they're always interviewing different companies and entrepreneurs. So it's just a great way to kind of keep your ear to the ground of different businesses and what's really happening in the business world and the financial sector. Another avenue of the online suggestion is online. So the benefits is it's easily searchable. Everybody's got Google, Bing. You type in a company name, type in anything on stocks, and you're going to get a million responses. It's also available through your mobile access. So if you got a tablet phone, you can go research and do all this stuff online from anywhere you're at that you got a connection. And a great part about this is there's a lot of free information out there for you. Unlike the print, where you have to usually pay a subscription, this stuff's available and easily accessible for the most part. News aggregators. I use MarketWatch as an example here, but there's hundreds of them. Even these print magazines have their own type of online sites that are free for for a lot of their articles. So you could still go out there and research and get some company ideas. With that, you can go a little bit further and find other places that are very specific to a target. So there's some that are very specific to penny stocks, or some that are specific just to biotechnology if you're really more into that field. So you kind of understand what you're interested in, and I'm sure you could find a niche on the internet of somebody who's collecting information and providing information about it. Blogs. I like to read a few of the different blogs. More for market analysis, because these are people that have either been in the market a while before they've done their own services, or they're in the market now and they're just, that's just the way they communicate and try to draw people into their services. But they usually give a lot of great information on just the market outlook. And then also, again, niche blogs, if there's a biotechnology or it's just straight up technology, they tend to focus more in that area. So they're always researching and doing stuff throughout the day and then providing those insights out to their followers. And then communities. Has anybody ever heard of StockTwits? This is kind of one that really came to my mind. This is just it's like Twitter, but it's very focused for just stocks. So a lot of people will have their own blogs or places where they can do a full in-depth analysis, and then they'll put a 144-character post on StockTwits talking about the different stocks that they're looking at, and usually a link to a fuller analysis of those different stocks. So if there's a few stocks that you just particularly watch, if you got a list of 10, you could probably find a couple of people that watch those same 10, and if you watch them track the performance, they might be one that you start to follow and can gain some insights from them. TradingView is another one. This is one that's come up recently, and with that one, it's a little bit different. They've got a chart on the website, so if you look up a company, they'll have a chart, and then they'll have people that keep posting their ideas to those charts. So it's a continuous flow of information based on that one chart that you're looking up. Another one is just your broker. A lot of your brokers now have their own communities where people are posting their ideas and talking about different stocks and sharing their knowledge. So there's a lot of different ways you can get information online, but again, it's information that you got to take and go look at it, continue to analyze it yourself to make sure it fits within your structure and strategy. Last one is stock picking services. This is a draw for a lot of new traders. The reason for that is that they're still learning and they're failing, so they feel like if they get a service that they're going to succeed because they're following somebody who's shown that they succeeded. But the problem is you never know if they've really succeeded or if they're just blowing hot air. But I'm not discounting them all, because there are people that are very honest and do want to help people and are being profitable and offering their services as a stock picking services, but also helping you learn how to trade as you follow them. So they tend to do a lot of the research themselves and pick the stocks, and then they send out an alert to you for you to go out and pick the stock. You often get notifications for buy and sell, and then allows a new trader to kind of watch over their shoulder as they're learning to trade themselves. So some services offer like some training, some online training, and then they implement that through the stock pick. So you can kind of see what they're doing, go back and analyze and see why they picked it and how it came about. And a good one will tend to follow up and say, well, this is why and how it fits into my strategy, things like that. So there are some that are beneficial and can help, new traders learn and develop their own strategy. But with the cons, they can be expensive. Some of them don't care if they're teaching you how to trade. They're just giving you stock picks. And you really can't always rely that they're going to do the right thing that's best for you. So they're going to do what's right for them. They're making the money. They're selling a service. But I'm not saying that everybody's bad, but you just really got to be careful on what you're doing out there. Next one is sector rotation. A lot of our stocks, especially within the United States, are categorized into different sectors, and then those are subdivided into industries. I'm just going to kind of give you an example here. So right here are your basic sectors that almost all of your U.S. stocks fall under. We're looking at about 9 or 10 different sectors there. And then those sectors are broken down into industry, and you have a lot more. So almost all your U.S. stocks and other stocks will fall in these different industries. So how does that really apply to sector rotation? Well, as many of you know, securities do not move in straight up or straight down. They kind of move in cycles. They ebb and flow. They expand, they contract. If you look at a 20-year chart, you'll see a stock kind of go up, go down, go up, go down. And the rotation strategies, the sector rotation strategies, really kind of go through and look at the different sectors and then look at the different industries and trying to find the areas that are the strongest at that period of time. So while energy might be going up, another sector will probably be going down. So they'll be getting out of that sector and then trying to get into energy. So they're just trying to always follow the sector that's rising and getting out of the sector that's falling, and just kind of understanding those different cycles. One thing to be aware of is that with any sector type rotation strategy is that the economy can always overshadow. So even though the different topics that we'll be talking about today, the economy can override that cycle. So if it's a really bad economy like in 2002, 2009, it brought a lot of stuff down. There wasn't much that was really rising during that time. So one strategy is what's known as the economic cycle. So you have your growth period. It's where the economy is improving, things are really starting to scale up, money's starting to go out to different businesses, consumer goods are going up. So what you want to look for is different sectors that are improving during this time. A couple sectors are the consumer discretionary and then financial sectors. Consumer discretionary because a lot of people are starting to get more money in their pockets, they've got some good savings, interest rates are kind of low, so they're going to start spending. Financial sectors, businesses are starting to grow to get the supply out for the increased demand. They need money from the banks. The banks are starting to make more money because they got more loans out. So these types of sectors start to rise during a growth period. During this time, utilities and telecom start to decrease. A peak area is when you've grown, now you've kind of topped off and you're kind of sitting there and everything's still running smooth, but growth is starting to slow down. Consumers' confidence is still strong, but it's starting to wane a little bit. But during this time, information technology and industrial sectors are doing pretty good. And again, utilities are not doing so well. So after a while, everything's been going great. After a while, it has to kind of contract. This is when companies start looking to save some money, so they start cutting jobs. Unemployment starts to rise, earnings start to deteriorate. During this time, energy and materials starts to increase, while consumer discretionary and information technology sectors start to drop. And then the last one is recovery. We've kind of been in a recovery growth for a while. Consumer staples and utilities usually grow. And when you're in the recovery stage in kind of the contraction, this is where the items that you can't live without. So you're not going to go out and buy a new car, you're not going to go on vacation, you're going to make sure you have food on the table, heat going in your house. So those types of sectors will definitely start to increase. And then because everything's in recovery, production's starting to slow down, usage of technology is going down, so that's why those sectors go down. So these are just some common ones, but you really kind of want to just look at it yourself and just be aware. These are just some kind of common scenarios. So, but what you can do, I just want to kind of go over and how you would research that. One thing I didn't mention is the sector rotation primarily focuses on just ETFs. So an ETF is an exchange-traded fund, and basically they're an index-like security that was developed to follow a certain benchmark. Excuse me. A lot of them are based on indexes, but some of them can be based on sectors or a very niche component that they're trying to emulate a benchmark. So right here are some of the major ETFs. These are more of the global ones that you can find. But what I wanted to point out were these U.S. industries. So these are very common ETFs for these different sectors. Doesn't have really volume there, but you tend to really want to focus on very popular and high volume ETFs. You don't want to go for anything that's very low volume because they tend not to move and you're just very sporadic. But what you do first is start at the sector level, and you can kind of see here that you've got the 1 month, 3 month, and the last. So what you're kind of looking for is a change from the 3 month, the 1 month to the kind of the current value, and to show that it's increasing. So once you find once you find one that you've liked, then you kind of go further and go, well, utilities is really kind of improving, so that's a sector that I want to get into. So then you're going to go a little bit further and go into those different industries of utilities. John, you had a question?
What's the weighted alpha?
Yeah, I was looking at that. That's actually something specific to bar charts. And if you look at it, it's basically a rating system, what they feel is the strongest contender. So if you were to kind of look at that, the most current, the best sector that they feel right now is more of the information technology and industrials.
Would that correlate with the beta on stock or delta?
I have no idea. That's really a bar chart. I didn't do a whole lot of research into that. But it's just their little indicator or ranking system. You could go out to bar charts. I'm sure they got more information out there to do some research on it. But you can see that if you just go on the weighted average, information technology, industrials, and materials have a very strong weighted alpha. But to be honest, I don't really like them because I see there's a lot of negative numbers for that 1 month. But you can kind of see here for like energy, it's kind of been a slow growth. But utilities has been pretty strong. So you might want to really go more towards utilities. And you can also just click over here and just view the current stock chart for that ETF. It's not a great one, but you can see that utilities is a very strong sector right now. It's a very strong uptrend. So you can go, well, that's very interesting. Let me go start looking at ETFs in that sector. From here, there's a menu on the right, and you can go ETFs by sector. And you're going to get all the different ETFs, and there's multiple ETFs for each industry. And unfortunately, they don't really list the industry that they're in, so it's a little confusing there. But you can narrow it down on the left here. So I just want to get US ETFs. And then I think I said utilities. So I go down to here and select utilities. Now that filters out the ETFs that fall within the utility sector. And now I can go and research these to see which ones look the most promising. So that's kind of an example of how you would go about doing the sector rotation. And then if you click on performance, you can actually see the last 1 year, 3 month, and 1 month, and you kind of see which ones are growing, have been growing over the last year. So this is how you kind of do the sector rotation. This isn't something that you would have to do every night. You probably wouldn't even have to do it weekly. it might be this is more kind of a long-term investment. So you might do it every couple weeks just to look at, see everything's still moving in the direction you want. If not, look at the next, start redoing the whole cycle again. Start looking for the next sector. If you're starting to contract, go find the next one that's starting to grow. So it's something that you don't have to spend as much time every night. It's more of a longer term solution strategy. Here are just some other rotation strategies. These are more, again, based on the different cycles that the stock market will go through. One is the driving season. As we all know, come winter time, we all start, especially up north, you don't do a lot of travel unless it's down south. So a lot of people tend to stay home, don't do a lot of vacations. But come start spring, spring break, summer, people start getting in the family car, driving cross country, flying, seeing family, doing trips around the world. So energy starts to improve because now demand has gone up, therefore price has gone up. And therefore the margins are going up, which means more profitability for these companies. You typically want to get in before the season really starts. You can kind of get in at the low point, and then you want to kind of get out near the end. So, once you start getting into the fall, near the end of summer, that's when, a lot of the travel starts to end. So again, you want to really just watch the charts, but these are just kind of common strategies in a cycle that tends to occur over again and again and again. Another one is the fall holiday season. This is great for retail companies and manufacturers who make the stuff for retail companies, consumer discretionary. As the fall starts to approach, people are starting to buy new clothes for school, and then it continues on and starts to ramp up for a lot of the different holiday seasons. So like Christmas, Thanksgiving, Halloween, we got all those different things that we're always buying, stuff to put around our houses and gifts for our friends and stuff like that. So the fall and holiday season is very strong for the retail company, and that's when they start to tend to grow. And another one that I found was the presidential cycle. And what this really is kind of saying is that once you have a new president come to term, that first year is actually pretty hard in the stock market. A lot of stocks tend to fall because there's a lot of uncertainty. They don't know how the president, what his goals are and how he's going to react to international type crises and then what kind of policy he's going to implement locally that's going to affect them. Like Obamacare really affected a lot of healthcare. So there's a lot of uncertainty of what they're going to do. But the longer they stay in term, the better the market, because they start to get familiar with who the president is, and they start to feel more comfortable with what's going on. Now, obviously, if there's a policy that he's going to change, it's going to affect an industry, that could be negatively or positively impact that industry. So it also helps understanding how those policies affect those different sectors. Another one is the top-down approach. This is almost exactly just like the sector rotation strategy. The only difference is that you're not using ETFs. You're actually scaling, you're still looking at the different sectors, going down and then trying to find the best industries within those sectors. But then you're actually finding individual stocks within that sector. And what this is you're trying to find the strongest stocks within that sector of a positive sector. Or if you're a short seller, you're probably looking for the weakest sector and then finding the weakest stocks that are going to fall the greatest. So it all depends on the type of strategy you're looking at. But what you're doing is you're starting at the top level sector, finding the best or worst depending on your strategy, scaling down or drilling down a little bit further, finding the industries that are the best or the worst within that sector, and then finding the best or worst stocks within that sector. Again, all based on your strategy. And you always kind of want to look at a different time scale. So you just don't want to look in the last week or two to see what it's doing. You want to look at it overall. So, again, because it's a cycle, it's going up, it's going down. So if it's been going down and it's kind of at a valley and it's been kind of sitting there, that might show that it's kind of hit its worst part and it's going to be hitting a recovery and growth stage pretty soon. So that might be a good sector to kind of keep an eye on and maybe jump in pretty soon. It's kind of more of a long-term strategy. It's not something you got to go and look at it every night. You're looking to ride that wave for an extended period of time, so you can spend less time researching and reevaluating your portfolio. My favorite, the stock screeners. My favorite because I'm a developer, so I like programming things and tinkering. But basically a screener, or as I often call it, a scanner, is software that will filter out stocks based on criteria that you provide. You have a lot of different screeners out there. There's a lot of free ones, a lot of paid ones, and everything in between. They typically will be based on fundamental data, or they will be based on technical data. Some are actually based on both. So it all, again, depends on the type of screener, type of trader you are, and what you're actually looking for. Each execution of a scan can actually provide a new list of stocks. If you're an end-of-day trader, your scan, you can run it 100 times. After 4 o'clock, you're going to get the same stocks. But if you're running it throughout the day, things can change, especially if you're a technical analysis type trader, and that's what you're screening on, and especially if you're doing a short-term type screening. So if you're screening on stuff that's based on a 5 MA, 5-minute moving average, that's going to be constantly changing and, running. And that's something you're going to want as a continuous type scan, where it's always just always flowing and changing the list based on your criteria. But at the end of the day, you're kind of a little more longer term time frame, and you're just going to run once at the end of the night, get a list of stocks, and then kind of start your analysis through that list of stocks. Like I said, some screeners actually provide additional ranking along with the stock. So that all depends if that's something that you like. So we saw bar charts there had a weighted average. I think Stock Charts has a sector type rating. I think it's like 0 to 100 that they feel is that they rate. I don't know the criteria. Another one is the Market Club, but that's a paid service. So there's a lot of different screeners out there for you. It just all depends on what you need as a trader. So here's again something that I just talked about, the Market Club, stockcharts.com. That's the one that I worked with for a while in the beginning. It was very technical analysis driven. They had a really good tutorials on it, and I picked it up pretty quick and easily. And it was pretty low cost for me. I didn't have like a great broker and could do anything with that. So it was a really great start for me. Barchart.com, I showed you that with the sector a little bit. That wasn't really so much a screener, but you could filter it down to get into different sectors that you liked. Finviz.com, that's another one that's pretty good. I don't like it as much myself. It's just because you can't get very specific on it. They give you a lot of drop downs in a lot of different fields, which is why it's good in some aspects, because you got a lot of different pieces of data that you can search on, both fundamental and technical type data. But again, you're limited to a very small subset of values you can search on. So it is nice, it's free, and it has all this different data, but it's limited on what you can search on. So you can get a bigger list because you can't filter it down as much as you want. And also your broker tends to have a lot of these screeners for you built in within your brokering package. Just depends what type of broker you have. So kind of back to what I was talking about, stock screeners here. This is stockcharts.com scan criteria. And basically this is your work area where you can type in your different scanning criteria that you want to look for. So right now this is just the default they put in there, saying that the type, I'm looking for a stock, I'm looking for a daily simple moving average of 20. Now it's actually looking at the volume because that's what the volume stands there. So they're looking for a volume that's over 40,000. So you're really going to get a lot there, saying that anything where volume was over the 20-day moving average of 40,000. So if you just run scan, it'll probably give like a lot. 600? No, it's probably going to. So it only goes up to 999. So it's that's just way too many. So here, if we break it down a little bit again, I'm looking for stocks. Only stocks that are within the country of the United States. The daily volume, a 60 moving day volume of over 300,000. You can increase that to 500,000, a million, whatever. But that's a great thing about this. You can really pinpoint what you're looking for. The next criteria is that the daily high is less than yesterday's daily high. And then yesterday's daily high was less than 2 days ago. So you can actually go back in time and look at different candles and different highs and find out which ones that meet all those criteria. And you see that I've got a lot of ands, so everything has to be true. You can also put ors. You could put some in parentheses and ors and ands. It can get very complex and crazy if you really don't know what you're doing. I've gotten lost in there myself several times. Then I'm also looking at my moving averages. So my 9 EMA has to be greater than my 30 SMA, and my low has to be less than the actual EMA. And I was looking for stocks that were greater than 50 cents, and the stochastics, which was less than 50. So we can easily change this. So, 50 cents is kind of ridiculous. Let's go to $5. And 300,000 really isn't much, so let's go to 500,000. So I've really so this is kind of when I was just playing around with penny stocks. I was just trying to find some cheap stuff, but now I'm like, I'm a little smarter. Let me go find stuff that actually had some volume and that actually was a real stock. So if you remember, we had like 388, so now we scanned it down to 277. You're like, man, that's a lot. So you could come back and do some further scans, but I just want to point out some of these. So now what you would do is start looking at your, So basically you can kind of see here just from that first one that I called it a bullish scan. And basically what the scan was trying to do is finding stocks that have dipped down below between the 9 EMA. So basically it's been in an uptrend, but I'm finding the dips is what that scan is trying to do. Now the scan isn't perfect. I still get a lot of junk in there because it's hard to really get a perfect scan. But what you can do is then you start finding these and you go, wow, that's a great uptrend. It's starting to dip down. This is a stock that might go into my watch list. So going, okay, now if it breaks above 13, that's a buy zone for me. So kind of going back to the screens here, so you can see that the screen that I had was a bullish screen that I created to find dips within a trend. The first stock I pulled up happened to be a great example. But like I said, there's always going to be some that don't really follow that. So we come to this one, and we go, yeah, it's pretty ugly. I don't want to deal with that. So screeners are great because it does narrow your screening down to, narrows the field of stocks that you want to look at each night or each weekend. But it's not always 100% perfect. So I just wanted to point out another one that I did like, just because of its simplicity and its range of information that it provides. This is called finviz.com. It's free, but it also has a paid subscription that provides more information if you want it. But you can go here to the screener, and then you've got descriptive, fundamental, technical, and then all. So these are all the different data components that you can actually search on for FinViz. So if you wanted a market cap that was, mid, you could just do within that range, or you could do everything that's over the mid-range or over, or anything that was under a large. So you do have a little bit of options there. So if we went just to a mid-range, if we were a fundamentalist, we could go where PE is over 25. I really don't know. I'm just making stuff up here. But then you can actually search on patterns. So if you know chart patterns, you can actually search on different price patterns. Insider ownership. You might want something that's a little bit higher because they really believe in the company. You can do it on the 200 moving day average. So here, this is an example of why I personally didn't like it as much, because I can only search on the 20-day, 50-day, or 200 moving day averages. So if you're more into technical analysis, you're probably going to have like a 9, a 10, a 20, a 25, a 30, 35. Can't really search on those here. So you're very limited on what you can search on, but you still do have a lot of different information. And also, if you know any candlestick patterns, you can actually search on different candlestick patterns. So we want to do price that's over $5. And price 10% above the 50 MA. And I didn't find any stocks, so it's a really bad scan.
The insider ownership is probably different.
Yeah,
It's good for a lower view.
I have no idea. I don't follow.
I would definitely, I would go with 15, definitely, probably 12.
Under?
Yeah, definitely.
All right. So now we've got 9 results. So you can play around with those different drop downs. So if you're not very technical, you find that programming a little too much, this is a great opportunity to make it a little more simple for you to screen and find some stocks. So again, with these, you get the list, and then you still got to go out and look at it and just see if you like the stock. What's nice is you can just hover it and see a basic a stock chart right there. I think that's, is that a 1 day? No, that's 3-4 months. So that's a 4 months. So you can kind of see that it has been going up, but it's nearing a resistance zone where that gap down is. So there's a good potential that it could hit that and stall and drop a little bit. So right now you might just be going, well, this is looking good, but it's not something I want to buy right now just because of that resistance zone. So this would go into a watch list, and we'll go over that here in a minute. So those are the different type of screeners that we have out there. And if you guys ever have like a strategy and want some help with like building a screener, if you let me know what your system is, I can, come meet with you sometime and help try to build a screen for you. I'm happy to do that. And then I'd like to take that screen then and post it to the group. So if you do let me help you, I would like to try to share it with everybody. So just kind of keep that in mind. And I'll actually take mine that I put out there, that I already have out there, maybe make a couple more. But if you guys got some ideas and want to shoot them to me, I can try to build a scan from that too, and just get them out to the group if anybody wants to check them out. So we've done all of our analysis. We found all these wonderful stocks going to make us millions of dollars. So what do we do with it? So you're going to build a watch list. Well, what is a watch list? It's basically a list of securities that the trader is monitoring for potential trades in the future. You can generate the watch list through all these different analysis avenues that we've talked about. I see watch lists that have being really 2 different types of watch lists. So you can do this daily analysis, weekly analysis, monthly, yearly, whatever strategy you have. Do change your watch list. Pull stocks out, put stocks in. To me, that's a dynamic watch list. It's always changing based on what the current conditions of the market is. Another one that a lot of people tend to use is a static watch list. This is where they pick their best 10 stocks, 50 stocks, 100 stocks, and they just use that same list over and over and over again. The benefit of that is that you get to know those stocks. You know what the companies are doing. You see the business cycle. You see the ebb and the flow. So you become very familiar with those stocks and can become profitable with them if you've been using them for a long time. The dynamic ones are nice just because you're always taking advantage of the best market conditions based on that time period. So it's all again up to your strategy and what you prefer. But either way, you always want to keep the list fresh. Even if it's a static list, you're always going to want to kind of do some additional analysis and take out stocks that are really just not performing or really not following your strategy anymore. Like if they have a lawsuit and they just drop and then are just flatlined, then you want them out of your list. They're not helping you. You're just taking up your time. So then you can run maybe some new scans to try to find some new potential stocks or companies to put into your watch list and then start managing those. The other thing is to keep that list manageable. You don't want to have a watch list that's 1,000 stocks long. You're just going to drive yourself insane trying to manage that. I know myself, I have a stock list that's 120, which is a lot. And I found that I really can't go through it every night. So what I've started doing is that's what I'm calling my master watch list. And then on the weekends, I have more time, so I'll spend actually a few hours going through it and really drawing my lines, seeing which ones are potential trades for the week, that are close to support or resistance zones or close to a pattern that could break. Or if it's a channel, where it's near the top or where it's near the bottom. So I take those and move them into like more of a weekly watch list. So then during the week, I'm just watching that smaller list of just the ones that are currently active, that are close to what I want to buy. And then I also will take it further, and then if any ones that I'm buying, I put into an active trade watch list. So those will always be the first ones. So if I'm running out of time and don't have a lot of time, I got 15 minutes at the end of the night before I go to bed, I'll just scan through my active trades, make sure there's nothing I want to get out, set up any sell alerts tomorrow. If there is, get them set up, and I don't look at anything else. So it helps me break down and minimize my work for the week and the day, depending on what my time schedule is. But some people, they just look at 10 or 15 stocks, and that's all they look at every night, 10, 15 minutes of their time, and they're done. So it's just all a matter of how you trade and how much time you have to dedicate to this. And like I said, it should be manageable. Set a limit for yourself. If you find that you want to add a stock, find a stock to remove. Otherwise, your list is just going to keep growing, and it's going to become unmanageable for you. So that's it. Is there any other questions? Anything you guys want to discuss?